My name is Jerry. I'm a sophomore, and I'm joined by Kimberly, Leslie, and Sam. We're all from Queen's University down in Canada, up in Canada. So yeah, we're going to be pitching a short position on Warby Parker. So I guess first off, what is Warby? I'm sure a lot of you may know Warby Parker makes glasses, so prescription lenses, contact lenses, sunglasses, and so on. Now, in its original form, Warby Parker was part of this wave of e-commerce companies trying to build premium brands at really discounted prices through going direct to consumer. So no middleman fees, no licensing costs, no expensive network brick and mortar stores. And now, recently, Warby Parker has been expanding aggressively their retail footprint. So now it's playing catch up against these really large, well-established players in an already pretty saturated industry. So interestingly, its shares have been up, appreciated 35% over the past 6 months. And we attribute that to three main reasons. First, it recently announced an insurance partnership with Versant Health. Second, it is actively pursuing social media partnerships. Most notably, they launched a product line with influencer Emma Chamberlain. And third, management has revised much more optimistic top-line guidance that investors have fully bought into.
So on top of all of that, we think a lot of immense media attention over the 2 months have made Warby fan favorite in their success story. We see headlines about their expansion plan that has them more than tripling their stores, right? And we see comparisons to Ross or Ava, which are completely different business models than eyewear retailer. All of this, which I believe is overshadowing company quarterly losses, and Warby Parker has not been profitable since 2019. So what are we looking at here? We're looking at an e-commerce disruptor that has failed to disrupt the industry, but has a formidable fan base with a lot of investor interest. Therefore, we think they're being priced for perfection. So we did a reverse DCF to kind of look at what the street is baking in for the stock being worth $16 per share right now. We're seeing a lot of optimistic sell side buy targets, a lot of recent bullish commentary on store unit economics, partnerships. But what does this really boil down to is when we look at their implied brick and mortar growth algo, you're looking at 40 net new stores every single year. You're looking at mid-single digits same store sales growth, which gives you a 10.6% revenue CAGR. You're looking at 50 bips of gross margin expansion per annum, as well as 156 bips margin uplift. So you're basically looking at a complete turnaround narrative with margins completely reflecting, and this needs to happen for 10 consecutive years for Warby to be worth $16. And we disagree. We disagree because we think that the stock has substantially benefited from short-term, influencers, partnerships that are distracting investors from the deteriorating business fundamentals. We think this is really a melting ice cube with no room for turning. Our thesis really boils down to 3 parts. One, we think their bull story has already deteriorated. They already failed to achieve their original value proposition. 2, the company has several red flags within its business model. And 3, their top line growth are those. Therefore, we're pitching an implied downside about 50%, suggesting that the stock price should be.
As part of our first thesis, we believe that Warby Parker has failed to deliver on its original value proposition. Historically, the eyewear industry is dominated by 2 players, EL and DSP, who actually distribute glasses to all of the brands shown on the left. So Warby found its initial success by offering more affordable glasses within an underpenetrated region of the market. But then shortly after, EL then began acquiring online discount retailers like Clearly or iBuy Direct that was able to undercut Warby in price. Without brand equity or necessarily pricing power, Warby has failed to deliver on its value proposition, instead trying to stay afloat in an incredibly competitive landscape.
So in this first thesis, we really wanted to try to answer what is Warby's value proposition from an in and out of network perspective. So essentially, majority of Americans are going to fall out of network for Warby because essentially Warby's in-network insurance partners only cover roughly 20% of insured Americans. And so essentially they're having a huge issue with constrained customer reach via their limiting insurance network. And essentially, we saw a brief run-up in their stock price, essentially due to their recently announced partnership with Versant Health and essentially ability to acquire roughly 15 million in-network insured Americans. And we believe that the market overall has a very bullish view of this partnership and views it as very important to their growth algorithm. However, essentially, we believe that because Versant Health already has existing in-network eyewear retailers like America Best and Target, which are relatively cheaper than Warby entering into this in-network space with essentially no lower cost competitive advantage, it's going to be very difficult for them to essentially attract and retain in-network customers. And the second part of this is Warby boasts that their eyewear is essentially cheaper even without an in-network discount. However, primary research shows that across a variety of different plans. Essentially, Warby Parker ranks the most expensive or the second most expensive relative to other comparable kind of eyewear companies like LensCrafters, Iconic, and EyeBuyDirect.
So as part of our first red flag, we'd like to really dive into this active customer metric. So we actually conducted a waterfall retention analysis where we split active customers into new customers who typically spend more on their first purchase and returning customers who spend less. So from this analysis, we saw that during COVID, there's an influx of pent-up demand, helping increase purchases during this time period. Now, this cohort will return in 2023 to 2024, meaning that as new customers decline, because there is such a pent-up kind of returning customer base with lower order values, this has actually caused the sell side to misconstrue future ARPU growth. When in reality, we believe that ARPU growth will slowly slow down due to the lack of differentiated products that Warby Parker offers and their lack of pricing.
So essentially, the second red flag that we see here is Warby aggressively spending on SG&A and marketing expense in order to compensate for their weak value proposition and limited insurance network. So essentially, in 2023, marketing and advertising expenditures were roughly 65% of revenue, and SG&A was roughly 69% of total sales. And overall, this has reflected unfavorable LTV to CAC ratios at around 0.6 times, primarily due to higher customer acquisition costs.
So this leads us into our last red flag, Warby stock-based compensation structure. Not only is the assortment of their peer group incredibly misconstrued and also just like completely random, we found that Warby actually bases its compensation off of top line revenue growth and adjusted EBITDA rather than profitability metrics like ROIC and operating income, which is what its closest peer National Vision uses. So we find this extremely concerning because Warby's SBC makes up 77% of their adjusted EBITDA, masking about 33 million up in losses on their income statement.
Right. So we touched upon the main red flags in the status quo. Now we want to look at the future, right? How viable is your expansion strategy? So 40 stores per year, every year for the next 10 years, driving double-digit sales. That's a really impressive sales story, growth story. But beneath all that investor optimism, we think that there isn't a story here. Because if you look on a unit economic basis, per store revenue has actually been declining significantly. And this is where we deviate from consensus same store sales. So going forward, we wanted to really get a sense of what, beyond just declining unit economics, we want to conduct some independent analysis and really get to the roots of why this strategy is impaired. So we web scraped some data. We actually conducted a proximity analysis of every Warby Parker location against the top 5 eyewear retailers in the US. And we actually, this revealed significant saturation. So in fact, I think 72% of every Warby location has at least one competitor within a 1 kilometer radius. And in order to hone in on more recent store openings, by comparing the store openings, so the competitive proximities of store openings before and after 2022, we actually found that their new stores are actually opening in increasingly subpar regions due to, and even though this could be, we recognize this could be a positive thing, they might be going to where their competitors are in order to steal their customers and steal their labor. However, we don't believe this is the case because 2 metrics really steal the deal for us. Number one, 27% decrease in population density and a 12% decrease in median household income. Now, even if all this alternative data isn't convincing enough, there's another factor, and that is supply side constraints. Now, most notably, there has been this really broad-based optometrist bottleneck that is further amplified by Warby Parker's notoriously poor optometrist experience, and at the same time, it being one of the only eyewear retailers that has the most dire need for optometrist hires. So all of these combined drives our conviction that their top line growth algorithm is indeed broken.
So kind of to summarize where we really deviate from the streets, it's new store openings, same store sales, revenue per store. And then on the customer side, this would be ARPU and active customers. All of it are easy. This kind of gets us to a 58% implied downside case valuation and about a 23% 2-year IRR. Now, what I really want to focus on is actually the scenario analysis and where we look at kind of the asymmetric risk reward opportunity. So even when we look at the bull case, this is in line with management on 40 new stores per annum. They doubled their store count by 2029, and you're getting mid-single digit same store sales growth by 2030. You're still only seeing about 6% of upside just because of how much of that is already paid share price, right? But if you look at our bear case or a base case, you're seeing that even if they just taper down to 4% SSS year over year, they're not getting nearly as that. Now, in terms of how we get paid, we really think that there's three main drivers. We think that lower productivity in new locations will reveal diminishing store unit economics. Post-COVID retention rates will be realized by the street, leading to consecutive top and bottom line misses, all of which aligning investors with our view that their growth algorithm is impaired. Therefore, we think it's a very compelling short opportunity.
I'll shout out the question. So you glided past here that Warby Parker was developed here at Wharton, right?
Yes.
And there was a time when Wharton students always heard the Warby Parker story, the buy one, give one thing. It's a public benefit corporation and all that stuff. That didn't even come up here. I was curious, do you think of that like it's just like a broken business model? That was maybe a gimmick at the moment. Now it doesn't seem to even show up anywhere in your discussion of the competitive situation at all. And also, it's a public benefit corporation status change affect your thinking, and their A share B share structure affect your thinking about this being taken private or anything like that?
Right. Yeah, I think I can start off on that since they've had a lot of innovative gimmicks. That'd be one of them. They also had a really innovative home trial program. They also wanted to be the first e-commerce like disruptor, and they were pretty much not successful in all of these avenues. They were originally e-commerce. Now they've shifted towards brick and mortar, which is essentially what all these already established players are doing. They had that home trial program, realized that everyone actually doesn't want to buy them online. They wanted to go in store. They wanted to take the exam. I think 80% of Americans actually buy their glasses after going to the same place, take an exam. So a lot of these gimmicks, we don't actually see them translating into the numbers. For instance, I think customer retention rates, I don't know if you guys have anything to add about that, but customer retention rates have actually also been masking profitability. The way they're reported, I think it's, I don't know if you want the.
Yeah, I can hop in right here. So basically, after looking at expert calls and TV interviews, we found that typically after 2 buying cycles or roughly 48 months, customers will leave Warby Parker and actually continue buying from another glasses company like EL or VSP, like the ones that we mentioned. And part of the reason for this is actually because Warby Parker uses cheaper materials to pull off their glasses. So when I looked at like Reddit reviews or just like Google reviews, stuff like that, like people were complaining like, oh, like my lenses crashed, so I'm going to switch over to another brand. So even though they have been receiving like a lot of marketing exposure, once customers actually try on their products, they kind of don't see the value proposition that the firm really offers, and that's why they switch over to it.
Yeah, and maybe just touching on a bit more on the cover appendix, like we think the take private risk is kind of mitigated because of really where they play in the competitive landscape, right? Whether it's a strategic or sponsor, we don't really see a lot of synergy because of kind of where they are positioned. It is not anywhere close to the luxury players, or it doesn't fit in like kind of the lower, more functional, more affordable price range. And then to answer your question on the Class A, Class B structure, I checked on like iBorrow this morning, and it was I think 900 shares ago short with a 0.3% for their Class A share.
A quick one. As you think about the risk case on the short, you mentioned at the beginning of the presentation that a lot of the share price appreciation guiding ahead of street, and you've done work on the long term. How do you know they don't have another guide raise coming, or when do you think they'll be unable to raise the guide or be unable to guide ahead of street anymore?
Yeah, I think really in the short term, like I think within like 2020, 2024, we're really in line with street. We are baking in that they're, they end up opening as many stores as they do. But I think what we're really going to see is more so the long-term pressures start coming within the next 2 years, because really how they're expanding to new areas, they haven't ran into that density problem like before. We're seeing it to come up more and more in expert calls. And we think kind of the business is going to hit a flat wall because they've only switched from e-commerce to brick and mortar not so long ago. So I think that's why we don't think we don't have connections there. Anyone else?
I think there's also inflated sentiment behind the company. Going back to the point on Versant, which was initially mentioned in our investment thesis. Okay, essentially what's happening there is with Versant, people are very excited because they're saying that roughly 15 million in-network customers are going to be joining the group. We don't think this is necessarily going to happen. Essentially, within the Versant, big retailers like Target and also America Best, which offer cheaper options relative to Warby. So if someone's continuously buying from these 2 retailers, what's going to stop them from, or really what's going to incentivize them rather to shift to Warby? And we really don't think that big catalyst that they're trying to sell the market now is really going to be realized essentially.
A question from Zoom.
Curious how you'll know if you're right.
Yeah, so I think we want to, obviously, we might not have all the details, but we're just students, but some things I think we want to keep a look at is kind of like looking at their acquisition spend, as well as the payback period for these new stores, right? Maybe looking at, 2 to 3 years down the line, what is SSS, and then what is the productivity? Because I think what we're going to see for a lot of these new stores, the productivity efficiency is not going to be efficient as some of the other stores we might have opened. And once we start seeing kind of these fissures appear in our new store openings, we believe that investors could become aligned with our view into thinking that their top line is impaired. Same with just more things from insurance partnership. Like this Versant partnership was a huge driver, but do we actually see it materializing? I think there's a big probability there, and they've done so, other types of partnerships in the past, and not all of them have been as successful as they marketed. Like I think that ties down to a lot of the headlines I bought initially. Like all these headlines, they're talking about how, like this one, for example, right? They've seen the biggest gain in nearly 2 years despite a quarterly loss, and they've never been profitable. So I think it's a lot of these ad hoc, marketing initiatives, not necessarily changes in the business model.
Hey, could you guys share?
What's the flip side? What would you need to see in the short term, given you don't have misses to that might give you some indication that you're wrong? Sorry to whoever I spoke over there.
No, that was going to be a very similar question to what I was
sorry,
asked.
sorry.
It's perfect. No, it's perfect.
Right. Yeah, so I think the main parts that it's going to come back to the expansion story. I think we have given it a 2-year ramp, but within the near term, we don't believe, because I think something I didn't touch on too much was, first off, on the demand side, we have been noticing that management has been expressing a really recent intent on expanding to these more suburban regions. Whenever you're in like you see a Warby Parker store, but these suburban regions, even though I think the median income is a bit higher, the population density is a lot lower, which I think was one of the criteria that we did notice in terms of looking for a store location. So recent initiatives in the suburbs, that's going to compress same store sales within the short term. We believe that can materialize. And on the supply side, we see, I think to elaborate a bit on what I touched on earlier was, out of all of these eyewear retailers, Warby Parker only has, I think, 0.8 optometrists per store, whereas the industry median is like 1.7. So they have that demand gap, and they are the company that is pursuing the most aggressive growth. So in order to meet that difference in optometrist hiring, they really do have to find themselves navigating a really challenging environment with rising wages, lowering graduation rates, and on top of that, I think there's some private research showing that there is a lot of negativity surrounding optometrist experience. So I think that's going to compress the gross margins in the near term as well.
And just one more thing about that. I mentioned the retention amounts because their latest earnings report only shows the last 48 months of data, which we think still can be misleading in the fact that a lot of these people were those COVID returnees. The way they count their active customers versus new customers acquired is quite confusing. And that was kind of highlighting one of our red flags. But we think if we're seeing, like a retention rate turnaround or, differences in how TGIS or earnings calls come up, that's a sign of, our customers really here for the long term. Or is it just more of that super cyclical and their bond?
Could you guys share whatever work you've done on margins? Because my initial reaction to this was amazing work, really, really thoughtful. But if you were pitching this to me today, I'd say the stock is down a lot. The short interest is like 16%. So it's like high-ish. And they're turning profit, at least on a non-GAAP basis, EPS positive and cash flow positive this year. So there's like a weird, interesting inflection point, and you guys don't think like the business is going to miss any time in the super near future. So I think you have to get comfortable that whatever your assumptions are, they flow through to margins in a material way in the near term.
I think maybe touching on the margin. I think in terms of gross margin and SG&A, we are pretty aligned that there will be an inflection. But kind of coming back, sorry, it's too many slides. I don't like, but what I was mentioning in our reverse DCF was when we look at the gross margin and EBIT margin uplift every year for the next 10 years for that to happen, we really do believe that is healthy. And even if that does happen, we come back to $16 per share, right? So what I think we're trying to kind of, convince investors, or how we think investors become aligned with our view is they look that, even if the street is right about the margins turning. The top line growth won't be there, or in terms of the CapEx spend per store, they will end up having to pay more for, ultimately straining free cash flow. We do also think that if the business will turn free cash flow positive soon, but we can attribute that more to operating leverage that, is associated with the margins, but that isn't necessarily kind of the full impact point of our thesis, if that makes sense.
Great, we should cut it there.